Corporate bonds are driven by yield, which is the coupon payment divided by the current price. Yield and price move in opposite directions. It sometimes takes a while to get to grips with this. An article talking about pressure on bond prices is actually describing the same thing as one which talks of soaring yields. If a company gets into difficulty, its bond yield will rise as the price falls, reflecting an increased perception of failure. But this also offers potential for a better reward for new buyers if those difficulties are overcome without default. As always, assessing bonds is a risk-reward trade-off. The same thing happens with interest rate changes. If rates rise generally, a bond with a fixed coupon will be less attractive compared to others, and thus its price will tend to fall and its yield rise. Bond investors also become familiar with the term spread. The spread, or yield difference between top-rated AAA corporates and benchmark government bonds, and the spread within the corporate market from the best-rated AAA issuers to the junk market of sub-investment grade issues. There are yield curves too, which measure the rates demanded of bonds of different durations. These are all affected by changes, some of them subtle, in the wider credit market and by global macroeconomic news. Changes in perceptions of inflation, of government finances, and many other factors all influence benchmark interest rates and will change effective yields, even if the spread remains the same. Just as there are bull and bear markets in shares, there are long cycles, sometimes many years, of good and bad performance in bonds. The day-to-day stability of bond prices can sometimes mask these subtle long-term changes. But for the long-term bond investor, they remain an important influence on the success of the investment. The value of investments can fall as well as rise, and any income from them is not guaranteed. You should be prepared to lose your investment. Past performance is not a guide to future performance. When buying gilts and/or bonds, you should consider the issuer's credit rating and their ability to repay their debt. This will have a direct bearing on the value of the investment. Should the issuer default, they may not make interest payments or be able to repay your money.